Boom! It is Wednesday. It is hump day. Happy Wednesday. Welcome back to Benzinga Live, everyone. How are we doing today? Let me know in the chat what stocks you guys are watching, what trades you guys are making. Quick rundown for the day. Today, we are going to talk about CPI and inflation, obviously. How the market has reacted to that. Of course, the number coming in at 9.1, a little bit higher, 0.3% higher than expected. But honestly, the market digested that. Dumped this morning and then has now been coming back. We were actually green for a minute on NASDAQ on the Qs, maybe a little reversal there. But we will also talk about in general why I think the bottom is not in yet. We will bring on Jack Rains from Young Money and Liquidity. Excited to get Jack on. So go ahead and smash the like if you're here. We'll get more people filing in from live trading. Let's go ahead and roll that intro and get the show started.
This is Benzinga Live. Spencer Israel and producer AB. What's up, everybody? How we doing?
Someone told me buy high, sell higher.
Let's get Matt Hammond on the show to talk some IPOs. Jake Wojacek from Trend Spider. We have a
breaking news. All right, guys, so let's go ahead and get my Benzinga Pro pulled up. Of course, the biggest story from this morning is that CPI data. If you guys were here with us yesterday, I was playing on the bullish side, trying to I thought there was more upside, just seeing if we did get a surprise beat. You know, everyone was expecting the number to be high, expecting the number to be bad. I think that we had those expectations set that it was going to be high, the CPI number was going to be bad, and then it even was worse than those expectations, of course, driving the market lower. But like I said, we took that dump this morning. Qs were down about 2%. We digested that and then now have since come back. Let's get those Qs pulled up. We're down about 0.3%. Let's pull up a 10-minute chart here so we can see this is where the number came out. We were actually up about 1% pre-market on the Qs leading into the print. Took a big dump, went down about 3%. What up, MD? How we doing in the chat? How y'all doing today on this? It's kind of rainy here in Detroit. I don't know where you guys are joining us from. Maybe we'll do that today in the chat. Let us know where you're joining from. You don't need to, share your address or anything like that, but maybe just a state. Let me know. Like, I'm in Michigan. I'm in downtown Detroit. But anyway, so yeah, the Qs you can see had this big comeback. We actually went green for a minute, and then now in the last 20 minutes or so have given up some of those gains. So it looks like a little head and shoulders here forming on the intraday chart. If we get down to this level down here and bounce from there, that could actually set up for a nice short up here on the right shoulder. I like to wait to get on the right shoulder if I'm going to buy any puts or anything, because if we come down here and then bounce again, assuming a head and shoulders, on that right shoulder, if you get into a short, is your most optimal time, because you will get this leg down and then also the potential that you could even break this support here and move lower. So we'll keep monitoring the Qs. I mean, look, the title of today's show is The Bottom Is Not In Yet. And we'll talk about this because looking at a daily chart here on the Qs, we can go back to June 16th is basically our lowest point in the last few months. Well, really our lowest point since the bear market started. And at this point, everyone, on Twitter, Reddit, wherever you were, StockTwits was saying, okay, like that we're for sure heading to a recession. Everything's selling off. And then we rallied from here. The Qs actually rallied about 6% from here on the bottoms. Let me give a couple zooms here so we can see what I'm talking about. Went from about 277 all the way up here to almost 300. So about almost 25 points here on the Qs. We rallied, and then the sentiment kind of changed, right? People were like, all right, maybe, this isn't so bad. Some people were even saying maybe the bottom was in. But we've since given up a lot of those gains. And now we're going back to retest these levels. And this will be important because if we break through these mid-June levels, then I do expect we have a lot further to fall. And not only from a technical standpoint, you do have news catalysts coming. We have earnings coming the end of this week with banks. And then up until these next couple of weeks, we will be getting Tesla earnings. We will be getting Apple earnings. We will be getting Microsoft. So we will be getting a lot of catalysts here if we are going to make that next directional move down. And that's what my prediction is going to happen. This is not investment advice. Of course, I don't have a crystal ball, but if you put a gun to my head and you said I had to choose, do I think the Qs are going to be higher or lower a month from now? I would say lower. And then I think once we get those earnings, potentially bottom out there on the sentiment, and that's where it could be a good opportunity to potentially go long, maybe here toward the end of the month or even into August. But guys, I mean, this is where you really cannot be in a position where you're fighting the Fed. I'll go ahead and pull up one of this is in memoriam of Spencer, because this was one of Spencer's favorite things to look at. But I'll go ahead and share my screen, the CME watch tool. So this is after today's CPI print. Basically, this is for target rate probabilities for the July meeting. Now they're giving it a 48% chance that we bump up to 250 to 275 basis points, which compared to yesterday, July 12th, 1 day ago, it was giving us a 7% chance of getting, and that would essentially be a 1 basis point hike for the Fed, which is a lot higher than the market was expecting. You can see a day ago, it was giving us a 92% chance that we would get just another 75 basis point hike. And then now that number has dropped down to 51. So we've gone from 92% getting that 75 basis point hike to now down to 50%. So basically a 50-50 shot that we're getting a 75-point hike, which again would be worse for tech stocks and growth, but bad for equities overall, bad for equities across the board. So we shall see. I mean, look, if it were up to me, if I were the Fed, I would, want to wait, just because I think we already have some signs that inflation. I feel like I'm a broken record here because I've been saying this. But if you think about when we're looking at the CPI on July 13th, basically 2 weeks after the start of July, it's a very lagging indicator. And I'll be honest. I'll be honest about what I got wrong about the CPI going into today, because I was looking at essentially the the data for prices throughout June, and seeing that they were falling for the majority of June, from about June 10th, June 12th on. Gas prices in particular, which have been one of the biggest drivers of inflation, have been dropping. Right, we can look at a month ago, so this would have been June 13th. Gas prices on average were above $5 a gallon. Now they're at 4.63. Even a day ago, they're lower today than they were yesterday. They were lower or they were higher a week ago than they are today. But when we're talking about CPI and you see that 9.1 number, that's the headline inflation of year-over-year inflation from last June to this June. So I was looking at it in too short of a time frame of a lens, saying, okay, we were dropping for the majority of June, so that should be reflected in the CPI. What I got wrong was the fact that if you're looking at last June's prices to this June, it doesn't really matter in that sense that gas prices may have come down from $5 to $4.90 a gallon maybe in June, because $4.90, even the price that we come down to, is still much, much higher than last June's prices, which I knew that, of course, that even though prices have come down a little bit, we're still seeing that inflation. But I think seeing that, it really was reflected in the sense that throughout June, even with the gas prices falling a little bit, they were still substantially higher than last June's prices. So interesting to see that CPI coming so much higher than expected, even with the higher expectations. I do got to give a shout out to Employ America, a good blog over here. I forget the main guy's name, but he's really good on Twitter. I'll pull up his Twitter here in a second. So he put out this yesterday, and this kind of flipped. I was very bullish going in, but then I was reading. Okay, it's from Skanda Amarnath, and he's a good follow on Twitter. I'll pull up his Twitter in a second. But he warned in May, peak inflation not so fast, my friend. Upside surprises loom large, essentially saying that the inflation number would come in higher than expected. And he essentially said that again this month, that even with the higher expectations, to not expect CPI to have a surprise beat where it comes in a little bit lower than expectations. So I just wanted to shout out that because it was a very good blog that he put out. I ended up reading it toward the afternoon, which it encouraged me to kind of hedge my long position going into there. So yeah, no, I mean, I'm not saying, Lisa, that we should be grateful, right? I've been over this, and I'm not happy about paying. Let me pull these gas prices back up because I'll show you. Even in here in Michigan in the Midwest, it sounds like, Lisa, if you're paying that much for gas, you might be in California or something like that, but or New York. But even here in Michigan, I mean, 474. I'm saying I'm not stoked about paying this either. I'm glad that it's at least going down. That the trend has been going from that it's been in a downtrend over the past month or so, the gas prices in particular. So I don't know. I mean, I think right now what you're seeing in the markets is some people, the people that are buying here, and in terms of buying just the broad based indexes or buying the overall market, you're hoping that we've seen peak inflation, that this last inflation print, the highest we've seen, 9.1, is peak. Going forward, it'll be lower. I'm done trying to make predictions on the CPI because for the past 2 months, I've been dead wrong on it. But I do think it'd be shocking now at this point to see it come in any higher than it has been, especially with fuel prices dropping the way they are, plane tickets dropping the way they are. Really, one of the biggest things right now still has been rent and housing prices. So we'll hope with the rising interest rates, and especially if the Fed ends up hiking the federal funds rates to 1%, that should increase mortgage rates even more, thus limiting demand, and bringing down the prices for homes even further than they've already dropped in the last month or so. So Lord Byron saying, I just buy quality names and funds and ignore it. Yeah, I mean, and that's the best way to invest. I mean, if you're buying, especially for the long term, depending on what age range you're in, if you're closer to retirement, then this downturn is a little more worrisome for you. If you have a long term investment view, my advice would just be to continuously add to your retirement accounts on these downturns. Because I mean, if we drop another 10% on the Qs, right, we're at 280 right now, 285, so that'd be about $28. We'd be around 250, we'll call it, a little more, maybe 260. So okay, so say what? So you're buying the Qs down here at 260 and you're down 25% on the year. Guess what? In 5 years, when the Qs are at 500 or 550, you're not really going to care that you were underwater for a little bit of 2022, especially if you keep adding and lowering that cost basis. We were talking about dollar cost averaging the other day and how it's actually a little bit more, or at least for myself, dollar cost averaging is actually a little bit more controversial in the investing world than I had thought. I thought it was just kind of accepted as this, sound investment strategy. But the problem is people start doing it in really speculative kind of bad names, right? Like some of my picks that I've been really underwater in, like I look at something like QuantumScape where I was buying in at $20 and now it's down to $9.50. If I had been dollar cost averaging from $20 down to $9.50 in a QuantumScape, I'm just killing myself. You're just eating your portfolio up. But if you're dollar cost averaging into something like the Qs or the S&P 500 or something that have very high conviction and historically has proven that it's come back and back and back, then you're going to be okay. I mean, you should be fine in the long run. And actually, there has been a lot of studies and info that has come out that's shown that continuously adding and holding into something like the S&P 500 or the Qs has actually worked out as an investment strategy better than what a lot of kind of essentially that type of portfolio, a buy and hold type portfolio, ends up outperforming a lot of even like active funds because what the S&P 500 does over time is it goes up. Doesn't mean it's going to go up every single year. Doesn't mean it's going to go up 10% every year, but that's historically what it's done. So it's so far working out, and that's what I'm doing right now. So I hope it continues to work out. All right, let me go ahead and get my Benzinga Pro pulled back up. We'll do some tickers from the chat, and then we'll do a rundown for the rest of the show. We are going to do a segment on beaten down growth names later. So we're going to look at some of the, biggest growth names out there from Rivian, which you can see has just gotten beaten up, gone from 180 all the way down here to 30, to Zoom, ticker ZM. And we're going to take a look at all these stocks and see which ones have the best upside. Your Shopify's, your Squares, your Ubers, and see which ones we like, which ones we don't like, see kind of how we're doing that DD. Shopify's chart, geez Louise, this thing is, even before COVID, it was trading, this is split adjusted, was trading at $55 a share. Now it's down to 30. So Shopify, you're now down to the COVID crash lows, March 19th lows, in Shopify. You got to wonder at some point, does this get interesting? But at the end of the day, this is an online shopping platform that got valued at I don't even know what it's still a $40 billion market cap. I don't even know what it was at its height. Yeah, we did. I did see some people in the chat talking about it. QS promised a little too much too early. Yeah, and QuantumScape is one of those stocks that and to be honest, I'm still holding my shares in my long-term Roth, and they're down. I'm down tremendously on them. But it's one of those stocks that even if I were allocating a portfolio for one of my friends, so I would allocate a portfolio for someone else probably way more conservatively than I would myself. But what I wouldn't mind doing is for maybe say you take 5 or 10% of the portfolio based on how big it is, and you reserve that for very speculative names like QuantumScape that have the potential to really 10x over a 10-year or 20-year period. Because essentially what QuantumScape or at least promised to do early was provide this technology that would revolutionize batteries for electric vehicles and really make them better in terms of able to go longer, farther range, and be cheaper for the manufacturers. So QuantumScape would essentially position itself to where it would be selling to every single. Tesla makes its own batteries, and that's a big part of its business, but outside of Tesla, essentially QuantumScape's customers would be every single car manufacturer out there. And I do like it as far as companies that haven't produced anything yet, but that have a lot of potential. QuantumScape is up there. The problem is up here where it really ran up and got up to above $100 a share. People were buying this during the time where that's where money was going to the speculation. You look at ARK, you look at ARKK, you look at where all the money was going during this time period, where interest rates were basically were zero effectively. Is that people didn't mind taking on the risk for this future growth, for the speculation. So people were buying this up here. And then, over time, growth kind of came more out of favor. And then, of course, the Fed starts raising rates, and this thing has just been brutal. It's been absolutely brutal. There hasn't been a time period for more than, you had this run up in November. This was kind of when we peaked out. We had kind of two peaks out in the end of November 2021 and then in the beginning of January 2022. But this thing, is so beaten up. But I wouldn't mind allocating 1 or 2% of a portfolio to some names like this that are so beaten down and that have a chance to, really appreciate over time, to really compound those gains. Quantum said BlackRock says they're not buying the dip and buy the dip investment strategy is over. Yeah, I agree. Just look here. That's what I'm talking about. That's why I brought up QuantumScape. If you were dollar cost averaging into this stock, that the only thing you're doing with that investment strategy is losing more and more and more and more money. But then if you do that, over time on the S&P 500, we'll take a look over here, and this is just daily. You're buying the dip here, boom, you're rewarded. You buy the dip here, boom, you're rewarded. You buy the dip here, boom, you're rewarded. Buy the dip here, boom, you're rewarded. This is just another one of those dips. It's a lot bigger. It's a lot bigger than basically any dip we've seen in the last 12 years outside of the COVID crash. And I also don't think we're going to see the markets come back as quickly as they have in the past with something like COVID. You got to think about what went into that COVID rally, right? Let's go back to a daily chart and go back there and see just how quickly we had this V-shaped recovery in mid-March, and this is basically kind of a month into COVID when fears are sweeping. I mean, businesses are closing down. The S&P drops about 25, or no, more than that. Let's see. I want to say the S&P 500 dropped about 35% in this like 2-month period. This candle about 8%, this candle 13, so about 21% that's not where the lows got to. Either way, just historic Federal Reserve actions taken during that time in terms of federal funds cutting rates. Solomon saying disagree. If you want to build wealth, don't bet on speculative companies like QuantumScape. You want big, not worth putting 5% into risk plays. Just buy solid companies. Yeah, I mean, I hear you. I think with that mindset though, you would have never invested in a company like Apple or Amazon in the early days. Gotten it. You could have invested in those like later on and still gotten great returns if you started buying Apple in 2010, 2013 or whatever, and have been invested for the past 10 years. But if you were building a portfolio in essentially 2002, we'll just say after the dot-com bubble crash, and you were looking at companies like Amazon and Apple, you would file them in this category of saying they're speculative companies not worth betting on. So that's why I think for me, it's worth kind of throwing at least a tiny bit of your portfolio into these names, and only if you like them, only if you do your due diligence, you look at what industry they're in, you look at the industry and think, okay, this industry is going to grow and this company is going to have a strong foothold in it. I want to have exposure to it. Sure. Then throw some money into some of these companies that are pre-revenue. But I'm not going to have a portfolio that's 50% QuantumScape or anything like that. And you could always go back and look at hindsight and say, oh, if I would have put, X amount of my portfolio into Tesla in 2015. I mean, yeah, of course. Of course. But there are 1,500 other stocks that if you would have put your portfolio in 2015 that you'd be down. So, yeah, Andy O in the chat saying what a start to the day. Just an incredible day. I mean, if you look at the market movement, we'll go back because I've been watching the Qs really most of the day. That's where my options trades have been in. We were trading up pre-market. I had calls at like 8:20. We were up about 1% on the Qs heading into the CPI print. I was feeling good. I was feeling good about my calls. And then because the way I saw it was the expectations were super high. And that 8.8 number. And my thesis was that even if we got like 8.9, or it was slightly higher, I thought, okay, like the expectations have been set, we'll hopefully rally from there. I think the number just came in a little higher even than the high expectations. 8.8 were the high end expectations, and it came in at 9.1. And then we got this sell off. But then we rallied from there, and I actually played it really well because I did have some puts going into it as well. So I sold those puts essentially right at the open for more than 100% gain. And then I took some of those profits from the puts and bought more calls. And then on those calls, I'm up a decent amount right now, 46%. At one point, they were up more than 100%. The problem is all the calls that I had overnight are essentially worthless. So I'm still down on the day, but able to recoup some of those losses there overall with that rally there. And of course, in hindsight, I wish I would have sold some of these. Andy, you were holding puts. Oh, you were holding puts into the day, then switched to calls? Hell yeah. And you played that really well too. Look, Solomon, just to be clear here. First of all, nothing I say on this show is investment advice. I mean, yesterday I bought calls on the show that expire today. Obviously, that's not investment. I hope that's obvious. That's not investment advice. But my point, I wasn't trying to compare QuantumScape to Apple. I mean, I did compare QuantumScape to Apple. I was just saying in terms of having the mindset for, okay, in black and white terms, I'm not gonna invest in any speculative companies. I'm saying then that would have prohibited you at the time from investing in a company like Apple or Amazon. I'm not saying QuantumScape is Apple. I'm just saying in general. So it's not, say it's not QuantumScape. Say it's a different potential big name, or not big name, but potential big growth play, that's a very speculative company and you love it, and it is, Apple in 2010 or whatever, then I think you can allocate a small portion of your portfolio to it, especially if you're younger and you're able to take on risk. If it's someone who's 50 and they, want to hold a portfolio for 10 years or 15 years before they retire, then maybe I wouldn't allocate any of that money to any speculative names. But if someone was 30 and they wanted to invest in a portfolio they were going to have for 20 years, I would look at some names like QuantumScape, that I thought would have the potential. I mean, another name like that, could potentially be like an Airbnb. I mean, Airbnb's got a pretty good moat. I don't know. I mean, this is a company I haven't done enough DD on to really decide if I like it long term or not. But I think Airbnb is a name, where I'm 25 right now. I think Airbnb will still be around when I'm 35 in 10 years. And you gotta think the business is able to grow. Um, but we shall see. Let me know. Let me know in the chat. Give me a one in the chat if you're bullish Airbnb, and I'm talking about long term. I'm not talking about the short term, because I think a lot of people out there, myself included, think there's definitely more pain coming out in the short term. But I'm talking about long term. I'm talking about 5-10 years down the road. Are you bullish Airbnb? Do you think the stock will be higher in 5 or 10 years down the road than it is right now? Let me know. We'll give the chat a minute to throw their guesses in there. I'll go full screen on this chart for a second. Easy Mike saying sell Airbnb. All right. You don't think so, Jet? You don't think Airbnb will be higher? Yeah, I mean, Lord Byron, 5-10 years. As a customer, Airbnb is cleaner. Yeah, I mean, okay, I think the company definitely has problems. People are pointing out in the chat in terms of just saying the company has like too many rules, has a lot of fees. I agree the company has problems. My biggest problem with it, my biggest problem with Airbnb that I wish it would do is I wish it would just list the price after fees and everything, like right from the get-go, so you don't see one price and then you're surprised at the end. I think it's annoying that you see a place for $100, then by the time you get through the cleaning fees and everything, it's way more. But I do think it has a very interesting moat. It's one of those companies that has kind of truly revolutionized its industry in terms of the travel industry. I mean, 10, 15 years ago, it wasn't even a thing. Like, you went somewhere, you could rent a house, and I mean, VRBO has been doing it for a while, and there were a lot of places you could go to do like rental homes. But most people did hotels if you were just going on a weekend with friends. And now Airbnb is kind of revolutionized this whole thing. And even though I've seen people complaining, been seeing people complaining about the Airbnb fees and rules and everything for years, and it hasn't seemed to really affect the demand for it at all. All right, so we should have Jack Rains joining us pretty soon, and then after that we will talk some more. Maybe we'll talk some growth names with him, but we'll see. Let me know in the chat. So if you, all right, here will be a good chat question for the chat. If you had to pick one growth name, and I know this is a subjective term, but one growth name, if you had to buy it today and hold it for 10 years, which would it be? One growth name to hold that you had to buy now for 10 years. I don't know. Judging by the chat, it sounds like no one's really going to be picking Airbnb. Sounds like we were pretty bearish on that one. I don't know. This is a tough question. I think it's easiest to first pick an industry and say like what industry that you are the most bullish on. And then from there, all right, so I'm seeing a SoFi from Buglug. Peloton. Okay, J Rice said just kidding. I was gonna say that's a very interesting choice. Tesla, I guess, maybe hard to pick. Palantir, Aaron Bryan, Shopify. I mean, yeah, we just looked at that Shopify chart. You're getting it at a discount for sure. If you like this thing at, if you like this thing at 176, and again, this is split adjusted, you should love it down here at 32. AMD will pass Intel. Yeah, AMD, Nvidia, I think are interesting just because they've been so beaten down. But numbers that have been coming out have shown that we might be going from a supply chip shortage to a surplus real quick, and that's that kind of bullwhip effect you can see sometimes in the supply chain. All right, guys, keep throwing those growth names in the chat because I'll save them, and then we'll take a look at each of them, or as many as we can later. Super Editing is asking, why is the market not falling? That's a good question. I mean, we talked about the market, the move the market made once the CPI data came out. And then once that kind of got digested from there, we rallied and even went green for a minute on the Qs on NASDAQ, and now back in the red but slightly. And I think to answer your question, Super Editing, and of course there's no one correct answer to this question, but bottom line, this was expected. Like the inflation number was expected to be high in June, right? The expectations set 8.8 were higher than the 8.6 than we saw in May. So if the expectations were already to see higher inflation in June than in May, and then we get the confirmation that, oh yeah, inflation was higher, it's like, no, duh. And then I think more importantly, you got to keep in mind that these are all lagging indicators. We're now 2 weeks into July, looking at numbers that really, stopped going into the CPI at the end of June. And we have other numbers to look forward to. We have bank data coming out. We have bank earnings coming out the end of this week, retail shopping numbers. So, the market's always going to be looking forward. And I do still think that the next big catalyst we're going to see as far as any big directional moves in the Qs or in the SPY will be once we get all the big earnings in the next couple of weeks, right? Apple reports July 28th. Tesla is the 20th. Microsoft is the 26th. So in about 2 weeks or so, we'll have all these companies reported. And, my one prediction is, I guess, I think the Qs will be either a decent amount lower or higher than they are right now. And we'll see some volatility. All right, guys. I do see our first guest of the day hanging out backstage. Jack Rains over from, he writes the Young Money newsletter. He's with Liquidity as well. So we'll talk to Jack about what he's been watching, kind of what he's been writing about. So whenever I get a little sign from him, maybe a thumbs up that he's ready, we'll go ahead and give him our special intro and bring him on the show. Hell yeah. Love that. Jack is ready. Let's go ahead and play that intro. Mr. Rains, how you doing today?
Aaron, I'm good, man. Thanks for having me.
Yeah, thanks for coming on. Welcome on to Benzinga Live. This is our kind of midday lunchtime show where we like to hang out, have fun, talk trade ideas, talk about what's going on in the markets. So welcome.
Cool, man. Thanks for having me.
Yeah, so just a quick introduction for our audience. Jack Rains, like I mentioned, you are the author of the Young Money newsletter. And you're with Liquidity as well, correct?
Correct. Yeah, I've got my Liquidity hat on right now. If anybody wants to buy one of these, we have them on liquidity.co. So instant marketing plug, but it's a good hat. We have sweatshirts too.
Hell yeah. Yeah, I've had Mark on the show a couple times. So Jack, let's start with just, I guess, some more background on yourself. How'd you, kind of get into investing, get into the finance world and get into writing?
Really the investing thing was, so I graduated from college with a degree in finance in December 2019. And then market volatility was nuts, obviously with the COVID crash. And then I started working remote like everybody else did in February, March of 2020. So I got bored and just started throwing money at different stuff because I was working from home and ended up trading SPACs a lot. and made a lot of money doing that, then lost some of the money I made. But that was my first real, I guess, market introduction.
Yeah, I kind of have a similar time frame in terms of like when I graduated, kind of right into COVID, and then I
Yep.
was also, trading. I was more trading options and specs, and made a lot of money. Lost some of that money, but that's where I was always into. I think business and investing, but that's really where I got like most active was during COVID. Um, so when you came out of school with a finance degree, did you want to go into like media at all, or did you want to do something like more like go work for a fund or go work for a bank?
I always kind of like the idea of like the hedge fund or asset management industry. I went to Mercer University, great school, loved it, but not at all a target for like hedge funds or really anything New York based. But I got into Columbia Business School through a deferred enrollment program when I graduated. So in my head, the plan was always work in finance for a couple of years and then go to Columbia in fall 2022, which is what I'm planning on doing this fall. And then after that, use the Columbia MBA to get into like either asset management, hedge fund, or something in higher level finance. Took a pivot with that when I started writing, and now I'm planning on really sticking on the writing path, doubling down on that. But yeah, that was never like that was not some initial plan that I had. That really started about a year ago.
Yeah, and honestly, I was kind of similarly like didn't really ever see myself in the media space of finance, but now that I'm here, I don't really see myself leaving. And even with
Right.
like if I have potential aspirations of managing money or a fund or anything, I know that that's not really a window that like will close. I can always like write and do media for 20 years, and then when I'm 40, if I want to get into asset
Yeah.
management, no, I can.
Yep. Yep. Agree with that 100%.
So what's so far been like, what are like the biggest, I guess, like bright points and kind of, I guess, like weak or like dark, kind of dark spots of your newsletter? I'm sure that it's not been just like even if the subscriber growth has been a straight path up, it's not, I'm sure, felt like that the whole time.
Yeah, no. So some of the bright spots are always when you have somebody who's like a bigger name or somebody with a large following that shares a piece that you wrote because it sort of vindicates or validates what you're doing, right? Like I've had like Nick Majuli, he just published his first book, Just Keep Writing, that he works for Ritholtz Wealth Management and has like a very successful finance blog. Packy McCormick, who writes the Not Boring newsletter, like both of those guys have at different times shared pieces that I wrote. And
Yeah, I've
Money
even
with
seen like Trung from
Yeah.
yeah, he's interacted with you on Twitter and
Oh
stuff.
yeah,
So
Trunk's great. But yeah, getting like recognition from these guys and girls like Money with Katie, who she writes for Morning Brew, like she shared a couple of my pieces. So you've got these like bigger, really established names in this sphere. When they've shared my stuff, that's obviously been fantastic. The low points were really the first 5 or 6 months or so. Just you've got a smaller audience, you're not getting a ton of feedback, and it can just get not boring, but a little bit disheartening, just like writing and writing and writing and feeling like, you spend several hours on a piece and then you kind of hear nothing back. But I think that's a pretty common part of the journey for anybody who's trying to do anything creative or like a little bit different. You have to get through those doldrums at the beginning of it to get to the growth on the other side of it.
yeah, no, 100%. And so I'm curious because like what's been so one of the things that's been so impressive to me about the Young Money newsletter, blog, whatever you want to call it, has just been its versatility. Like you go from writing about like life and entropy to writing about like valuations of a specific
Yeah.
company. And it's like, how are you kind of setting that agenda of like what you're writing about? Is it just whatever you're reading about and interested at that time, or
Yeah, no, that's literally what it is. So, for example, I was in Argentina for a couple of months in February and March, and like we talk about inflation's obviously a hot topic now because it just came in at like 9.1% today. But Argentina's month-to-month inflation is 7%, right? Like their annual inflation is over 50% a year. So that was a topic that was pretty wild to me. Like how did this even happen? really what's going. Obviously, their currency sucks, right? The Argentinian peso it just devalues really quickly. But I thought that would be a cool topic to break down, like historically, how their monetary policy got to the point that they have hyperinflation. Or I'll just be sitting there thinking about how I feel like a lot of people, especially our age, are so focused on either like pedigree or more materialistic stuff with their careers, or just money for money's sake, and write about that. Or, you see some of the insane stock bubbles, whether it's like the meme stocks or SPACs, some of the stuff in crypto. So if it's an idea that I think is interesting and I can make like a story out of it, then I'll do it. Because while we're all somewhat focused on finance and money and investing, like everybody that cares about that stuff also cares about a lot of other stuff, right? Like we're people, we're not robots. So if I'm interested in that stuff and also interested in some of this other stuff, then I just feel like other people will too.
Yeah, and that's where I think like one of, I guess, the biggest opportunities, especially in like financial media, is right now, is because like you said, like we're interested in all this stuff, but we're people too, and people are
Yeah.
drawn to stories, people are drawn to storylines, and there are so many people in this industry, in financial media, whether you turn on CNBC or Bloomberg or whatever, that are just sitting there in their suit reading the numbers that the S&P is up this much that day or down this much that day, the CPI was this, the CPI was that, and they're not really telling any like compelling or interesting stories. So I think being able to step in and do that in this industry, which is something that you're doing, is like filling a hole and something that's very valuable.
Yeah, I appreciate that. I think like one thing that to me was pretty telling was that Morgan Housel's book, The Psychology of Money, has sold over 2 million copies, right? And it's almost the opposite of it took an opposite approach to what most financial literature takes. Like there's very little on the strictly quantitative, like price to earnings, cash flow, I don't know, like GDP to market cap of the S&P, like all of the super quantitative stuff that you see in most finance. His is very qualitative stories about how like different people's behavior with their money over time, or how people view stuff. But it's like you said, people are very attracted to stories, right? So if you can take these really quantitative fields and make them more qualitative and relatable to just people's lives, people appeal to that.
Yeah. So have you read that book? Because I haven't, but I've heard good things about it.
Yeah, no, I have. It was I read it about a year ago, I guess, and it was, to me, it's been my favorite strictly finance book that I've ever read. I loved it.
Okay.
I've intentionally tried to copy some of Morgan's like writing style a little bit, where he pulls from like different stories from history and how they relate to stuff that's going on now, just because I think it's a very interesting way to frame financial markets.
No, totally. I've kind of been disappointed in the past with like a lot of strictly not like just book, because like anything Michael Lewis, like Big Short,
Oh
Liar's
yeah,
Birthday,
no,
like
Michael
that's
Lewis is great.
yeah, like that stuff is great. But then books where they're like for example, like The Intelligent Investor, I was kind of like underwhelmed by. I'm like, all right, like whatever, like stuff like that where it's supposed to be like kind of self-helpy money
Yeah.
books. I've been kind of disappointed by in the past, but I have heard good things about Psychology of Money, so I might need to check that one out. So you mentioned when you started, you were trading a lot of SPACs. Have you been active in trading or investing recently?
No, pretty much all of my money is in different index funds now. So for a quick, like, very short rundown of my trading journey, it basically went that I saw DraftKings was going public through a SPAC back in April of 2020 or whatever, and I realized that okay, I had never heard of a SPAC, but one of my friends who sports bets a lot was telling me they were going public, and if you buy the SPAC called Desert Eagle Acquisition Company, then once the merger's done, you'll own DraftKings. And I was like, oh, that's interesting. And then I started looking at how it was structured. And yeah, DraftKings has really had a parabola of stock movement since it went public. Um, but SPACs also have these things called warrants that are attached with them. So I think the ticker for the warrant would be like DKNGW, and the warrants don't trade anymore. But basically, I saw that when DraftKings went from like 10 to 20, the warrants went from $2 to $9 or something like that, because warrants essentially are a 5-year call option on a SPAC after the merger closes. And it hit me that like if you buy these SPAC warrants and then it does very well, the warrants will go up like an option does, right? The warrants will go up much
Right.
higher than the actual like shares will. And SPACs have a floor before the deal closes where you can redeem your shares for $10 cash. So basically, the warrants seemed like a mispriced call option to me if you thought that the SPAC was going to outperform in the short term. So I just started throwing all my money at all these different warrants, right? Like Nikolai Motors, I could tell pretty quickly it wasn't a great company, but people were really chasing that next electric vehicle startup after Tesla. So I put $6,000 in like Nikolai warrants and turned it into like 25 grand. And then I did the same thing with Fisker Automotive and then ChargePoint, the EV charging station, Lucid Motors. And I ended up parlaying at one point $6,000 into like $400,000 in about 9 months.
Holy
Now,
shit.
yeah, I know. I should have cashed out then. And that's what my dad said. But I was 23 at the time. And when you're 23 and you make like 8 times your salary, you don't stop to think, wow, this is a lot of money. You think I'm up 6,000%. And if I make another 150%, then I'll be a millionaire at 23. So I kept trading SPACs and that bubble obviously just got oversaturated. It didn't work anymore. And then I started trading companies that used to be SPACs where I thought I still knew them pretty well, but it was a lot riskier because with a SPAC, they have that $10 floor. So like you could buy SPAC shares at $11 and only lose like 9% maximum on your investment. And I started trading companies that weren't SPACs anymore and could theoretically go to zero. And then one of them bombed their earnings report, had all my money in it. I lost like 150K in a day. So after that,
Which one was that?
Catapult, KPLT. Let's see what I bet it might be under $1 right now. I mean, it's a dog.
Is this a buy now, pay later?
Oh yeah. KPLT.
KPLT. Oh, I was doing KA. There we go. Catapult. Oh,
Are we over $1?
Yeah, $1.19.
Yeah, if you look, you can see that real big gap down right there.
Right here.
Yeah, that was
That's
like
where you
3
lost
times my
150K.
salary. Yeah, just gone. But yeah, after that, I was like, all right, well, I'm probably not going to do this anymore. I mean, I still had like 6 figures in net gains, so I just threw it all in an index fund, like S&P index fund, and it what it really shifted how I looked at this stuff. It was like, okay, I could continue to actively trade and maybe outperform, or maybe not. I'd essentially done both, outperformed for a while and then got bodied. Or I could work on other stuff to build up like higher and higher income streams and then invest that higher income passively. And it was just like a eureka moment, right? Like let's say you have $50,000, right? And you actively invest it and you make 100% returns. You make like 50K in capital gains. That's great. That's phenomenal. Like really good performance. But if you could also generate $50,000 just through working through income streams, and it takes you less hours of your time to do that than it does to study the market, figure out your investments and all that, then you're making more return on your time by doing that and investing it passively than you are trying to outperform actively. And I think a lot of people miss that when you're looking at like, are you outperforming? They just look at the net financial returns and don't take into account how much time you have to invest to do that and what like the opportunity cost of that time you're spending.
Right. And I've tried to echo that before too, especially to some of my buddies who have like wanted to get into investing, like especially like during COVID and stuff. Like, because basically I was like, all right, if you really want me to help you, here's what we'll do. Like, I'll set you up a Robinhood or something. You're gonna make like monthly recurring investments into the S&P 500 or into VU or QQQ. You're gonna set it up to automatically reinvest the dividends, and you're just gonna delete the app. You don't even need to look at it. It's going to take $200 out of your account every month, and you don't even need to look at it. And they're like, well, like, couldn't I make more money if I, do this, that, and that? I'm like, yeah, but this is literally going to take 5 minutes of your time to set up. And then that's it. You never have to look at it again. And if you're making, 10% a year or whatever off no time, that has a better opportunity cost. And if you're making 20% and you're spending 3 hours a day or whatever, like, you got to think about what if you're doing something that's making you money that takes no time, that's like infinitely more valuable than something that makes you a little bit more money but takes up a lot of your time.
Yep. I agree with everything you said 100%. I've said the same thing to some of my friends too. You're right. Like especially during COVID, like people had way too much free time, and you're seeing you would see there were the overnight millionaire stories, right? Like there's somebody, everybody knows somebody who either bought Penn Gaming at the bottom and sold it at like 100 something a share, or they loaded up on Ethereum or Bitcoin or Dogecoin or some other growth stock, Tesla, whatever. And what gets missed is the 99% of people who bought the wrong thing or bought those things after they went up and lost like 60% of their investments because nobody's out there like actively just showing everybody they lost a ton of money. People will very gladly show off their gains, but nobody's showing off the losses. So people who weren't invested at all have this like conflated view of how easy it is to make a lot of money by trading. And it's not. Like very few people are going to pull it off.
Yeah, and so okay, so everyone talks about how like the COVID markets kind of brought that on, and that's certainly it's funny because like the fear and greed index has been a thing that Wall Street has used and investors have used like for a very long time.
Yeah.
But then during like the COVID markets, people started talking about FOMO and people like FOMO buying, and it's like FOMO, it's like the same thing as greed, where we just don't call it greed anymore, we call it FOMO. But essentially, like people, talk about the COVID markets in that sense, like that's where things got really crazy. But what I think is interesting, and I think Jack, like your and I's timeline is very similar in terms of like when we got into investing, kind of made a lot of money, lost some, but I've stuck around. But what I think is really interesting is just the fact that like if you look back, this is before COVID hit, right? This is where COVID hit in March 2020. This is Tesla's chart from January 2020. So this is before COVID was even a thing, was $86. In the months going into COVID, Tesla ran from $86 to $186, so more than 100% gain. And this is kind of where because I remember just seeing on Reddit and stuff, like people's screenshots of making like thousands of percents, like hundreds and thousands of dollars buying Tesla calls. And this was before Fed cut rate, COVID hit, like the markets were already kind of crazy. And that's where I got into. So it's actually funny timing wise. I downloaded Robinhood, traded my first option like here in February 2020. And then the market hit, COVID crashed. I was actually short going into the COVID crash because I was like looking at everything going on around the world. I remember specifically what it was. It was a weekend where Italy canceled its soccer games, where I was like, all right, this is Italy canceling its soccer games. That's like here in the US if we canceled all our like NFL games.
Yeah.
On a Saturday night. And I was like, all right, this is weird. Like that never happened with Zika. That ever happened with Ebola. Like maybe this is a little bit more serious. And I had a bunch of puts like literally within a month of me trading options. And then it had turned like $800 in my checking account into like 15 grand on these puts. And it was just like, oh, holy shit. Like that was my eureka moment. Like, oh my God, like this is awesome.
So I actually got like interested in it from the same thing. I graduated in December and then I was out applying for jobs. And then I was also on Reddit on Wall Street Bets. And it was Tesla and then Virgin Galactic was the other one that kind of started popping off right in February, right before the market tanked. And you're same thing. You're seeing people turn, a few $1,000s into like 100 grand plus. And it's just, it's nuts. Right. And, anyway, so I was also looking at the same forums, and when the COVID news started coming out, people were loading up on puts. I did the same thing. I think I turned like 8 grand into about 32 grand at one point, but I stayed short through the bottom because, as you probably also saw, people were dead set that SPY was going to 190, like the Fed couldn't stop it. So I basically round tripped like 8K to 35K back to 8K. And then I planned on not trading anymore. And then I got into SPACs after that. But I literally did the exact same thing you did. I didn't trade Tesla, but I saw it and then got in on the put train during COVID.
Yeah, no, I'm looking.
I was about to say, oh, no, you got it. Go ahead.
Go ahead. No.
I was going to say, I think the thing that is different now than just the traditional fear and greed index is that with Reddit, Twitter, just the ease of communication, and then especially with lockdowns, when everybody was also on their phones and computers more, it wasn't that the psychology or anything is different, but the speed at which information moves around is so much faster now that the second you see a Reddit post popping off about Tesla, it makes you want to FOMO into it. And you're another buyer putting buying pressure on it. And it just makes, and then there's a million other people doing the same thing. So more and more people are seeing this stuff faster and faster. So it over exaggerates. And quickens moves both up and down just because the information is exchanging so fast. And then there's zero commission trading now. So like in '08, for example, or like the dot-com bubble, even in the dot-com bubble, people were day trading on E-Trade, but the amount of like the sheer number of people online talking about investing just nonstop is just so much higher now that it just makes the moves a lot quicker, in my opinion.
Yeah, and I think that's, it obviously just comes with the, you look back at 2000, the landscape of online forums and blogs and stuff, and then now it's completely different. And to where, but I think, throughout time, you've seen cycles where the market gets really hot, retail investors come in, the market has a downturn, and a lot of those investors get flushed out.
Yeah.
And I think that's still the same. You're kind of seeing the thing where it's like history doesn't repeat itself, but it rhymes.
Right.
Where it's like the same thing happening. It's just on a different scale because of like what you're saying. Like, I mean, if you look at like Wall Street bets activity, a year and a half ago compared to today, it's crazy how much it's dropped off. But even where it's at today is much higher than it was 3 years ago.
Yep.
But yeah,
right there with you.
I was just going to show this real quick because it's kind of funny. This is my Robinhood account. This was March 20th, which was when the market was at its like lowest points. I don't really get the negative. I don't get why it says negative 12,000. I think that's because or 1,200%. I think because I've like taken out more gains from Robinhood than I've like put in. But I was the same way. My like peak of my portfolio was when the market was at its lows, and then I stayed short. I was looking at the same exact post you were talking about. SPY puts were going here, just came all the way back down.
It was I believe it was SPY 190, like June 19th was that was the one that I went with, and it did not hit. It as soon as I bought it, I think I bottom ticked it actually.
Yeah, because then especially at one point when like the market had recovered a few percent, like it was so everyone was like, all right, like what's going on? Like the economy's shut down. The market shouldn't be up right now. I'm gonna buy more puts. And then it just kept going up. And then it's like, all right. And then I learned how to kind of navigate. I learned I always just kick myself on that one where I was like, I was up so much at the market bottom. If I just would have like flipped and went long, like not even like long options. Like if I just would have bought the S&P 500 or something, would have made so much more money than trying to be so risky.
Well, looking back on it, it's like you're looking at what companies make up the biggest stakes in the S&P 500. Like Microsoft benefited from that, Amazon benefited from that, Apple benefited from that. All these tech companies, like most companies that are the strongest companies in the economy, weren't really all that affected. Like the companies that were hit the hardest were like restaurants, retailers, and then like travel, like Delta Airlines and Norwegian Cruise Lines. And those make up such a small percentage of the overall economy now that looking back, it was very stupid to just stay short the whole time because like I worked for UPS at the time, right? And I could tell from how we were doing and that we were working just fine, working from home, and we were a logistics shipping company. We were actually busier at that time because more people were shipping more stuff to home. And I should have extrapolated that and thought, wow, there's probably a lot of other companies even bigger than us that are doing well. But when you make a lot of money shorting something, that feedback loop makes you think, okay, then I need to keep doing this again and again. Because when you make money, regardless of whether you were right or just got lucky, you just assume that you're smarter and you get false confidence from that.
Oh, 100%. I mean, there were days where I made like, say I was up like $2,500 in my Robinhood portfolio again from like $1,000 initially in my checking account or like $800 that I like fully thought like, oh, this isn't so hard. Like if I did this every day, I can make $200,000 this year. Like I like legitimately thought like, oh yeah, this is like a realistic possibility. And then like you said, like, and I think there's also that aspect of like, because when I remember like holding, and actually a lot of you mentioned restaurants, a lot of that money I made were on Darden puts because I actually worked at a Red Lobster in college and I was still in like the Facebook group. And I remember people in the Facebook group were talking about how like, it was so dead. Like they were cutting shifts and and this was just when like COVID was starting to go around the news and stuff. And so I realized that like Darden and restaurants may be one of the most hits, made a lot of puts on that. But I think there's something to being that feeling of like you against everyone, when you're short and like you're against everyone and then you're right, like it feels even better,
Yeah, no, I agree 100%. It makes you feel like you're the next Michael Burry or whatever. I mean, that's the easiest comparison, right? You think it's a contrarian bet when in reality, there were probably more people betting on the downside, like at the peak downside, than there were actually on the recovery. But yeah, anytime you're going short and then it hits, you feel just 10 times more intelligent.
Right. Like I remember there were days where I was holding my puts overnight and like waking up for the open, and I'd see on CNBC like everything would be red. They'd be freaking out. People were like posting. I'd be like, "Ha, you idiots! Like I'm short. Like you guys are so dumb. Like I'm so smart. Like all this shit." And then 2 weeks later, all my gains were gone.
Oh no, yeah, we were like we had a whole group text of people that were shorting it, and whenever the jobless numbers came out and they were like through the roof, or like more lockdown measures, we were like, well, that's another green day for us, and it worked for 2 weeks, and then it flipped around and we got wrecked.
Yeah. So what are your just like overall thoughts right now on the well, because you mentioned you had worked for UPS, and that's been one of the things where a lot of people out there that are like super doom and gloom right now. I've kind of been sitting here and I'm like, all right, like, so what? Carvana and Twilio are like laying people off. Like, I'm going to be worried when like UPS, FedEx, Walmart, and like companies like that, if they're laying people off, then I might get a little more worried. Where are you at in terms of just like overall worry about the market right now in the economy?
I mean, I can't really speculate on the market because, like, again, it's kind of like we have no idea how far this is going to overshoot up and down, especially with inflation and all of that. But as far as the economy itself goes, I mean, you saw the jobless, or the new jobs. I guess it was last week when the jobs report came out, and it came out like 100-something thousand jobs ahead of the estimates, right? I think the thing is, a lot of the companies that are doing the layoffs now are like startups and earlier stage companies that either A, benefited a lot from COVID initially, and then they overhired by extrapolating that growth rate. Like Coinbase, for example, they went public at peak trading activity, and obviously they were crushing it because they're predominantly, most of their money comes from fees on trades. Everybody's trading crypto. And then they just did like a massive hiring spree. And then that activity slowed down and they couldn't afford that workforce anymore. They extrapolated at the wrong time. And a lot of companies did that. A lot of money flowed, like venture capital money flowed into startups at really high nosebleed valuations because they were comparing to Zoom at their peak, or Peloton at their peak, Coinbase at their peak. And now it's slowing down a little bit, and they just got caught upside down on it because they raised money at crazy valuations and overhired. But companies like UPS, FedEx, Walmart, they're fine. Like there's really no, the stock prices might be going down, but you're not seeing like thousands of people getting laid off by Walmart right now. So I think most of the economic damage is mainly stuck in like kind of the startup techie companies. Because if you go to your local Red Lobster or whatever, they're doing fine now. If you didn't have any access to any stock market news and were just going day-to-day life, it probably everything seems way better now than it did during peak COVID when everything was a ghost town, right? So there's obviously crazy stuff going on around the world between like Russia, Ukraine, China, this and that. And I have no idea how all of that would shake out and affect us. But it seems like people are living pretty normal lives if you get out of the like online finance investing bubble. So I try to focus on that. So I think things are pretty much fine. It's just everybody assumes it's doom and gloom.
Yeah, and I think I agree there as well. Like that's where I've been at, is like, it's like, yeah, if you're a company like Carvana or someone and your stock was up 150% and you grew a little too fast and you overhired, like I'm not that worried that Carvana's laying people off, or even honestly, even like a Tesla. Like Tesla is a stock or a company that grew a lot during COVID and made a lot of money. And if it grew a little too fast and now they're laying some people off, like it's like that happens in growth companies, and when you go through these cycles. So I think my concern about the possibility of like a true economic downturn and recession has increased over the past month or so, but I'm still not even at the level where I think most people, at least posting on like Twitter and Reddit, are at, where they think, it's 07 and 08 all over again, or .com bubble, and they're comparing it to that, where it's I don't know if it's in the same landscape.
Well, I think we have incredibly short-term memories about stuff like this. Like we were kids when 08 happened. So it's not like we were working age and really understood what was going on. But we've spent the last 2 years in these crazy financial markets where pretty much everything's just going up like crazy, right? And that was normalized, especially because a lot of people really didn't get active in markets until 2019, 2020. So our perspective of normal and the perspective of normal for people who are the most vocal online is like everything going to the moon, this and that, a zero interest rate environment, and making a lot of money. So people start losing money on the strategies that were making money. And I think people tend to extrapolate, oh, they're not making money anymore. And they broadcast that view on everything like, well, it's because the economy's going to shit or this and that. And, beyond that, stuff now just isn't the same as it was a year ago or 2 years ago. But I don't think it's necessarily a recession. I just think it's a reversion to the mean. It's just we got used to this euphoric state of everything going up. So when it gets slowed down a little bit, the brakes get applied. We think, oh, this is a recession. But in my opinion, it's just a return to normal. Now, we can overshoot it on the downside too. Like, I'm not going to try to predict that everything is going to be just roses and perfect. But I think it's more a mean reversion than it is a new recession.
Yeah, and I mean, so I agree with pretty much everything you said there, and I think I'm in the same camp where it's like, all right, I mean, here, let's just do this. Like, look, if we pull up a chart of the S&P 500, we'll go to a daily, we'll zoom out a little bit. Actually, we'll zoom out a lot of it. We'll go on like a 5-year time horizon. All right, so this is going back to 2017.
Yeah.
Right. There's an obvious kind of trend that the S&P does over time. It goes up, but it goes up at a certain rate, and you can see that here. During this is the COVID crash, it was going up at a faster rate than it was before COVID, right?
Yeah.
Like S&P 500 went up at a super fast rate throughout this year and a half bull run or whatever. So just by looking at like basic reversion to mean, if you drew a line from, which we can actually do, let me go ahead and get my tool. I gotta figure out how to do this. Oh, here we go. Line. I'm not really a big technical analysis person, but I know enough to be able to draw a straight line like this across the average, and then you can see that we just got overextended there. Like, it just makes sense, like you're saying, that we're just going back to normal. But what I think is interesting in that sense is if you bring that to like specific names, like I still think if we were talking about the market here and not the economy, like to get back to that normal, there's still some things like Tesla to me, like I'd rather see Tesla down at some like realistic valuations. I mean, it's still trading at a 61 forward PE, almost 13 price to sales. Like if we want to see this revert to the mean, like, do you think that needs to happen before we get to that capitulation point in the markets?
So with Tesla, like in Tesla specifically, is probably the last one that's blown up over the last 3 years that hasn't pulled back at least somewhat to its pre-COVID or like early 2019 levels. But yeah, I mean, I think that eventually you're going to see Tesla get back to a more normal range. I think it'll still probably trade at a premium to other auto dealers just because, or auto manufacturers, just because it's still growing faster. But competition's heating up, right? Like Ford has got the Lightning coming out. GM has a big chain of electric vehicles. Tesla just got jumped by, I think it's BYD. I don't know if I have that name right, but the Chinese electric vehicle startup. I know Berkshire Hathaway or Warren Buffett is invested there. But like Tesla isn't like it isn't the only show in town anymore in electric vehicles. And I get that Elon Musk is and like has been the best combination of both engineer and marketer for a company maybe ever. But at the end of the day, like an electric car is still a car, right? Like it's not a SaaS company. The profit margins on electric cars aren't that much higher than regular cars, like ICE vehicles. So at the end of the day, like once they've had kind of a story premium of being the only electric vehicle show in town, growing really fast. But as more and more companies start rolling out electric vehicles and that becomes the norm, they lose that premium. And then it's just, okay, should Tesla be worth 60 times earnings? They're growing a little bit faster, but should they really be worth that much more than Ford if they have the same number of electric vehicles in the US or they get jumped in China or the European markets? Like, I don't think so. I think Tesla is going to be a great company, but I don't necessarily think it's going to be a great stock from this point forward. Yeah.
Yeah, no, I love the way you laid that out because like you said, I mean, and I agree. It's like if you look at the market caps of like, it's crazy. Look at like Tesla has a bigger market cap than like Toyota, Ford, GM, all these companies combined. And it's like, okay, I get, like you said, why Tesla would trade at a premium. Does that mean it should trade at a 50 times premium compared to the other companies? No, I don't think so.
Right.
So I do think in terms of talking about kind of the reversion to the mean, return to normalcy, something like seeing Tesla come down to, and I'm not saying it has to come down to like a 5 PE or get as cheap as some of the other auto manufacturers, but to just see it come down to a realistic valuation would be more of a sign to me that like, okay, now a lot of the froth has been taken out of the market. Now is a time where maybe, we could see some kind of sentiment bottoming out.
Right. No, I agree with that 100%.
And then kind of, I think in the same realm, like we can pull, let me get my charts back up. Like we can pull up, a lot of charts here, whether it's like ARKK, and we go to a daily and just look at how a lot of these names have returned either to pre-COVID levels or even before there. And Tesla still hasn't in that same time frame. I mean, this is where we were before COVID. We're still way up here. So you compare that to ARK, you compare that to some other growth names that have come down. And to me, and like you said, Tesla's kind of one of these like last ones that hasn't. Like essentially every single SPAC has come.
The SPACs are, I mean, they're dead. They're beyond dead. It's awful.
Yeah, I mean, the average SPAC has to be trading well below $10, I'd imagine. You look at Clover, you look at, I mean, DraftKings is one of the ones that's held up the best, and it's still, what's Lucid at now? Oh, yeah. I mean, Lucid's doing pretty well, still $20. But to me, one of the other last things that hasn't really come down or returned to normalcy, in addition to Tesla, has been Bitcoin.
Yep. It's very interesting watching like how the Bitcoin, I guess, narratives have shifted from inflation hedge to, it's hard to call it an inflation hedge now after, I mean, adjusted for inflation, Bitcoin's down, I guess, like what's Bitcoin down year to date right now? Or what's Bitcoin down 1 year? Sorry, year over year, if we can pull that up.
Yeah, let me get you that real quick. I know from its peak it's down about, all right, so in the last year it's down 40%.
Yeah, so adjusted for inflation, it's down like 50%, right? With
Right.
the 9% print, give or take a few percent. So it's like the inflation hedge narrative's done. I agree. I mean, my personal take on Bitcoin is that it's never going to zero, just because there's always going to be some people interested in buying it, because anything that's worth, $1 trillion at one point, that, I mean, it didn't really have a fundamental to send it that high, so it doesn't have a fundamental to send it to zero either, right? So I think just the speculative nature of people is going to keep the price there. But it almost seemed like as the price went up, all these stories about like, oh, it's going to do this, going to do that, kept running with it. And yeah, no, I'm right there with you. It's still trading way higher than it was last year. But this is the first time that it's ever dipped below a previous peak. It's now down below its 2017 peak by a few $100s, which has never happened before. And I think that's a fairly ominous sign that it could keep falling from there. But also, if enough people buy it, it can shoot back up to 60K. I mean, you never know how this stuff's going to work, especially when it's not something valued on like cash flow or earnings or anything like that.
Yeah, sorry, I'm catching up with the chat real quick. Jay Rice, I don't know where you've been, but people definitely were saying even before. So here's the thing that really got me with Bitcoin and crypto is I always like understood, I guess, the technological like use case for it. And I think like I think Bitcoin will never be at like zero. But the way I think like people that were super into crypto were kind of hyping it up and pumping it up, just like kind of annoyed me. It was like, all right, so you're telling me this thing is like going to change the world, all this, like how? And they're like, well, it's like a more effective way to like spend. It's like, all right, I already have money. Like they're like, all right, well, it's like a big inflation hedge. And it's like, first of all, well, then it's just, okay, they would like conflate the argument, right? Because you have these people in like Silicon Valley that are really rich. And it's like, they talk about even before COVID or even before inflation was actually bad, they talk about how bad inflation is and saying like, oh, the real dollar is meaningless. It's worth zero. You need to buy Bitcoin for an inflation hedge. And it's like, no shit, you're going to think inflation is bad. You're living in San Francisco and paying like $30 for a meal on Uber Eats. And like, $8,000 for rent. But I think it's one of those cases where like people in technology that were like smart coders and stuff, it's like one of those things where like you're an expert in one thing, so you think you're an expert in everything. So then they think you're like an economic expert and talking about things they really don't know a lot about. And yeah, I mean, that's been proven wrong over the past year, that Bitcoin is clearly not an inflation hedge. And you can see it in real time. Like every time we got a bigger than expected CPI print, Bitcoin would drop. And it was like, wait, this is supposed to do the opposite. Isn't it supposed to go up as an inflation hedge? And you can kind of see that with gold too. That's where I think both anyone who's like a super big gold bug or a super big like crypto person, I feel like just gets their kind of narrative muddied by looking at things.
I've never understood the idea of there being just an asset out there that's guaranteed to match inflation one for one. I mean, I guess you do have the TIPS bonds that the government offers where you can invest up to like $10,000 in those. But as far as like a certain stock or like a stock, a crypto, just anything that could be like an inflation hedge, right? Like there's not I tweeted this earlier, but there's no magic bullet asset where you put your money in this and it's just guaranteed to work. And it's the fact that people kept looking for that. But one of my bigger issues with Bitcoin specifically is that it's simultaneously considered both a store of value and a currency, right? But if you want it to be a currency like the dollar, where you're exchanging it for goods and services every day, then you're having to sell it / exchange it. And if you want it to be a store of value, you need people to buy it and hold it. So the two like biggest arguments for it outside of inflation hedge are very like they're counter to each other. You can't have this everybody hold it till it goes up while simultaneously having it as a currency you're using every day. That ignores the fact that nobody actually uses it as a currency to begin with. But the arguments just they never really make sense. I really think Bitcoin's true use case is just making people rich who bought it before everybody else.
Yeah, and I think that's been one of the biggest problems about crypto in general. It's been exposed over the past like 3 years or so, is that like you said, you've had this kind of use case shifting around to kind of match whatever the narrative is at the time. Like is the narrative going to be okay that this is a better currency than the US dollar? All right, well then it better be stable. If you're going to try to use it as a currency, because if it's not stable, then I send you $10,000 to buy a car, and then by the time you get it, it's $9,000. Then it's not doing its job as a currency. But then if it's stable, then it's not doing its job as a speculative asset that can maybe get me rich. So I think we've seen that kind of use case argument deteriorate over the past like 3 years, where it's just been shifting from inflation hedge to currency to, all right, let's be real about what it is. It's a speculative bet. If you want to buy it and try to make some money off of it, sure, but don't buy it and try to tell me that this is, the currency of the future and going to change the world in all these ways, when in reality, if anything, it's probably a net loss with how much we're like, mining and screwing up the environment just to like mine Bitcoin.
100%. Especially now with the kind of the energy crunch that we're having everywhere with everything going on. Do we really want to pour the excess electricity in the middle of the summer in Texas, for example, into Bitcoin mining rigs? Like, I don't think that's the best use of power personally, but whatever.
Yeah, and that's what like economists at the end of the day, like your job or what you're looking at is like how to allocate resources to like create the best return for the public for whatever it is. And if you're thinking about like how many resources, whether you're talking about energy or even from a labor standpoint, like how many kids have gotten out of Harvard, MIT, Stanford over the past 5 years and gone into crypto?
Yeah,
probably thousands. Thousands that could have gone into like, I don't know, clean energy or like something like more productive. Which actually I had a guest on a few weeks ago, Robert McCauley. He wrote some posts for the Financial Times. He's like a big time real economist, and his argument was that crypto has actually been a bigger like net loss for society than something like the Bernie Madoff scheme, because in that scheme he was essentially arguing was just a zero sum loss, like money shifting hands. In this one, you have like real life resources taking out of the earth, like labor going in, like all these things,
all that intellectual capital, like you said, with the like top tier graduates that could be doing, like they could go be like doctors, scientists, engineers, and they're playing with internet money, right?
Right, exactly. I saw a comment from Andy O in the chat. How can you invest while Tether's still not blown up? Yeah, I think that's where I'm at too. Like, I think, once I see some of these more of these crypto projects and things getting blown up, Tesla down at a realistic valuation, then I'd be like, all right, now is the time where the dust has settled. The Fed has done its
Yeah.
job. Now I can feel comfortable investing again.
Yep. I'm right there with you.
All right, Jack. I feel bad. I usually have guests on for like 20 minutes or so, but I feel like we've been having a good conversation. So you've been on a lot longer. If you have to go or run, by all means.
No, I mean I've got a meeting in like 30 minutes, so we can keep going if you want to. I don't have anything planned.
Yeah, we're going till 1 p.m. the show is, so we're welcome to stick around for the next like 9 minutes or so, and then we'll wrap up for the day.
Well, yeah, let's keep it going. So what are you looking at right now, Aaron? Like stock wise, crypto wise, whatever. Like what's been on kind of your watch list lately?
Well, watch list lot wise, I would say nothing really in like the crypto world. It's just not really like ever been my big interest.
Yeah.
I'll say like, I don't know. I guess you could talk me into buying some ETH if it gets down to like 500. Yeah, I don't even know. Like, I don't even know then if I would want it, because then we'd go down another 50% from here, and I'm sure the sentiment would be pretty bearish then. But I don't know. Stocks wise, I do think so. Okay, I have my Robinhood portfolio where I trade options and I kind of YOLO trade, and I basically make like speculative bets, and it's very risky. But then I have my
Right.
my real portfolio, which is like my long-term investment portfolio, where I'm basically just like a long-term buy and hold investor.
Yep.
So my Robinhood portfolio, one trade I'm looking at is I'm looking at potentially buying some puts into Tesla's earnings. My thesis here has just been that, like, we know the previous quarter hasn't been good for Tesla. They've been laying people off. I don't think their sales or deliveries are going to be that great. And Tesla's really set a bar where it needs to show like sustained growth. So even if Tesla is growing quarter over quarter, like if they're not showing the same growth rate that they have been, I think the stock will take a hit. And so, yeah, I mean, that might be one where I just spend like $1,500 on 2 different put contracts. And if Tesla drops 10%, I can make, $5,000. If it doesn't, then I lost on that bet.
Yeah.
As far as my long-term investing, I mean, I'm pretty much like you. I'm in a lot of index funds and stuff. I do think at some point there are a couple growth names that I would find interesting. One is Rivian. Just because recently, I mean, Rivian was trading at for a minute there. Rivian's market cap dipped below its cash on hand. And I don't know. I'm here in Detroit, which is like Motor City, and I've been seeing more and more Rivians driving around. I think they're actually like pretty cool. So that's one where
I'm sorry. Keep going.
No. Go ahead. I was just gonna say like that's one where it would be more of like a speculative bet where I would like buy a few shares of Rivian to try to hold for like 5-10 years.
Yeah. So I actually like, as far as just the cars themselves, I think Rivian's great. And I've seen a couple in Atlanta actually. But I think it's a more attractive EV than some of the other stuff. And but it's still like and I could be off on this. I just Googled it right now, but Rivian's market cap just on Google saying like 27 billion. Like that's still, like, they have a ton of cash because they like raised a ton of capital. And I think long term it's probably going to be a good company because they've built a good product, but it's still like they just haven't delivered that many trucks yet. And at what point, I mean, they're still valued at like Rivian's market cap is that. What's like Ford's market cap is less than double that right now. And their enterprise value is higher with debt, but still Rivian sold at max right now a few thousand trucks. Ford sells millions, and they're just in the same ballpark. That just makes it tough for me to buy it. Like I would be much more inclined to buy a Rivian truck than the Rivian stock.
Okay.
I was about to say one other anecdote though. One of my I played football in college, and our running backs coach actually either went to high school or college with Rivian's CEO, and they're like, I don't know if they're close friends, but they're like, still acquaintances and in contact. So I thought that was I had no idea about that until he texted me about it like a year and a half ago. But small world.
Yeah, and I mean, I agree. Like, I think it probably still is overvalued from a market cap standpoint, and I think right now is probably not the environment you want to be going out and buying like highly speculative growth names that are very like pre-revenue. But This is just one of those names where I think there are some like interesting growthy names that have been beaten down so much where it's like, okay, if I'm 25 now and I want to buy some stocks to hold for like 10 years, I've just been trying to push myself to like find companies that are like even have the potential to potentially like 10x over like 10 years, like trying to find that like Apple in 2005, like companies that are established, but that really have room to grow. I don't know if Rivian's really that. As far as other companies that I like long term, I think like in the clean energy space, there's definitely some beaten down names that could get interesting, like something like Sunrun in the solar space. Actually, Array Technologies has been one of the ones I've been looking at the most in the solar space. Basically, what Array does is they make the technology that optimizes solar panels, so it'll make sure the panels like facing the sun at all times. And they have a patent on this technology to where essentially every single like solar panel manufacturer has to go to Array to like buy this part for the technology, and they have government contracts and stuff. So they have like guaranteed revenue coming in. And it's just been beaten down like to the point where it's actually, because of that guaranteed revenue, like pretty cheap. Like this is saying the price to sales is 1.6. I guess forward PE of 34 is still pretty expensive, but it's only a $1.6 billion market cap. So with an enterprise value of 2.7. So that could be interesting.
Something that I've looked at a little bit, and again, like I don't have any money in individual equities now, but we were talking about SPACs earlier, and I haven't really dug into it too deep, but the just general like idea or like the general like consensus around SPACs right now is that they're all terrible, right? But like DraftKings is a legitimate multi-billion-dollar company, like massive sports betting company. Now their problem is they're spending too much cash on marketing, and it's like, can they flip to being profitable? Because all these sports betting companies are just throwing cash and marketing to try to get market share, and then hopefully it sticks. And I'm not necessarily saying DraftKings is like a good buy, but I do think there's probably some D-SPACs out there that got just completely beaten down because they went public through a SPAC. But 90% of them are terrible. Maybe 95% of them are terrible. But there is a 5% in there that might be growing revenue quickly at like a sustainable profitability level where, you could turn around and find some home run shots. And if they have warrants that trade on the market, they give you like a 5-year call option on it. If it gets above 1150, like you can make huge returns. I don't know what SPACs those are. I do have just as a general thought without looking into it, the companies that were SPACs that went public earlier in the SPAC cycle are probably more likely to be higher quality. Like DraftKings, for example, is a way better former SPAC than some of the just random stuff you saw over the last 6 months, because there was just, I think, more due diligence done earlier, and it was easier for sponsors to underwrite that stuff. But I do think that there's stuff that could be dug up from the former SPACs. It's just a matter of, can you find something at a valuation that makes sense, that's actually like going to be profitable? I don't know what they are, but I think they're out there.
Yeah, I mean, I remember Laser, LAZR, was one of the first big SPACs. That one seems to be holding up a little bit better than some of the later ones. But like you said, DraftKings, like Lucid Motors, CCIV, some of those more early ones, I think 100% spot on, maybe a little bit more legitimate. And I mean, just think about it from a like investment banking standpoint, right? People saw these deals going through. Every time people get these deal done on both sides, both on the SPAC side and on the company side, they get paid out. So there's incentive to get the deals done. So all these companies just started rushing to get these SPAC deals done, to the point where people finally caught on that like, oh shit, this is a lot of like, there's a reason a lot of these companies are going the route that has less regulation than the traditional IPO route.
Right.
But yeah, I mean, for to answer your question, in all honesty, like I'm like you, I'm basically just making my recurring investments into my index funds every time I get paid. And I'm not really like, if I was really worried about the market dropping another like 20% from here or something, I probably would slow down or stop those contributions, but I'm really not. Like, I don't think the bottom's in. I think we've got a little bit more to go. And I know you'd rather talk about the economy than the market. But the reason I think I'm more bullish on the overall market than some people out there, even though I do think there's more pain in the short term, is just because I do think the economy is in a decent spot. I don't think it's as bad as some people think.
Yeah, I'm right there with you.
All right, cool, Jack. Well, this has been really fun. I'm glad I've got to get you on the show because I've been a big fan of your newsletter, been following you on Twitter. So we got to do this again sometime.
Yeah, 100%. Just let me know whenever. I'm always down.
Sounds good. So you're doing you said you're obviously doing your liquidity stuff like full time right now, and then you're starting grad school at Columbia in the fall.
Yep. So I'm starting Columbia in August and planning on still doing the liquidity stuff and also Young Money blog. And then just we'll see how everything shakes out over the next year or so. I'm not going to try to forecast what exactly I'll be doing or anything like that a year from now. Stuff seems to move pretty fast in the finance newsletter business, but it's been fun so far.
Yeah, well, just from me, I hope you stay in the kind of newsletter media space. I know it'll probably be it'll be tempting once you get to grad school to MBA to take one of those, investment banking jobs or whatever. But I like reading your stuff.
Yeah, man. Appreciate that.
All right, man. Well, have a great rest of your Wednesday.
Thanks. You too. See you, Aaron.
All right, y'all. That was Jack Rains. I'm going to go ahead and drop his Twitter in the chat. You can give him a follow on Twitter. I'll also drop a link. Well, I guess you can go to his Twitter and then find his blog from there. But yeah, guys, that was fun. Glad we got Jack on the show. Go ahead and smash the like. That will be a wrap for us today. We will have Money Mitch starting up. This stream will automatically redirect you to Money Mitch. You will not need to go anywhere. Mitch is going to be talking to Patrick Galley, the CEO and CIO of River North Capital, as well as Tom Donnelly, the data site CFO. So some interesting interviews coming up from Mitch. Going to go ahead and pass it over to him.
This is